Welcome to the Investing Podcast presented by Tusk Media. This is Outsider Trading, an audio and video deep dive into the people, places, and things that we find most interesting in the market.
Hey everybody, welcome back to the Investing Podcast. I'm Garrett Palmer, joined here by Matthew Krebsbach and Ben Nye, and today we're going to talk about four big oil companies, hit the high points of them and why you guys like and don't like them, and apparently you guys have opposing views, so this should be pretty interesting. The companies are going to be ExxonMobil, Occidental Petroleum, ConocoPhillips, and Chevron. Krebs, we'll start with you. Give us a little bit of background with Exxon, the high points, and take it away.
Yeah, so Exxon, I guess, is the largest U.S. oil company. I think it dwarfs Chevron by like 100 billion enterprise value-wise. I mean, even you're a big fan of Exxon.
I do like Exxon.
They're vertically integrated, have huge upstream segments, E&Ps, all the way down to refining and chemicals. It's just a massive player in the space.
All right, Ben, hit us with some Occidental.
Yeah, so Occidental, big player in the Permian Basin in Texas, West Texas. That's one of the lower cost asset bases in the United States. If you're doing shale drilling in the United States, that's where you want to be. So Occidental, big player there, 4.5% dividend yield, which is among the highest for U.S. focused E&P.
Right on. Krebs, let us know about Conoco a little bit.
Conoco, I think, is the largest U.S. E&P company. They have a lot of the unconventional type of assets like oil sands, that type of thing. They're also really gas levered, and they're one of the few that are focused on free cash flow generation, which is kind of rare in that space.
And Ben, what are your thoughts on Chevron?
Yeah, Chevron, it seems like they're trying to emulate Exxon in a number of respects. As Matt said, they're so much smaller. They are betting big on a percentage basis relative to Exxon on like these projects in like LNG. They're really doing this big in Australia, like the Gorgon LNG project.
They also have a ton of Permian acreage too, but just like they're just so big that's such a small piece of the pie to Chevron.
Exactly. And in general, they just have a larger oil-related exposure. They're more liquids rich than someone like an Exxon in terms of a barrels of oil equivalent production basis.
All right, and I'll start with you, Ben. If you theoretically had to allocate money only between these four companies, how would you weight each of these accordingly?
Yeah, so let's start off with the premise that I'm not exceptionally bullish on oil. I think that over time it will probably go higher. But when I talk about over time, I'm talking like 3 to 5 year time frame. So a long time frame. So I kind of view Exxon and Chevron as playing in similar spaces. I think that Exxon is more international and they have more of their assets outside of the United States. But I would say that Exxon, the correlation between Exxon and Chevron over the past 5 years has been 0.85, and that's just the stocks. And so it doesn't really make sense to own both of them, I think. So I would put 75% in Exxon if we were just talking about these four stocks. And then I'd put 25% in Oxy, because I just think Oxy has a lower cost asset base than ConocoPhillips. It also has a higher dividend yield and lower debt to capital ratio.
Gotcha. Perhaps I saw you kind of smirk when he said 75% Exxon. You seem a little bit more bearish on that.
He's a big Exxon guy.
Big Exxon guy.
I think you're more bullish on oil than I am. I think for it to actually go above like $60 a barrel for an extended period of time, that's going to take like 5 years, like 5+ years. So I guess I'll preface everything I'm going to say with I'm not that bullish on any of these companies because of that oil price thing. We were talking about before how oil has gone from like 54 to like 50 today. I mean, it's down, I think Brent's down like 6% today.
Yeah.
And oil companies themselves have been down a lot more than that. So I don't know if the oil companies are, following the strip like we were talking about. So I'll just throw that out there. In terms of what we're talking about, I think I think Oxy's the best because that's for you handcuff me really hard with these 4 names. That too.
Sorry.
I'll throw Oxy out there, but I think you have a huge risk with that dividend yield. I mean, that's probably what's like. It's been really stable. Like it hasn't gone up a lot when like oil was just headed like its run. It didn't go down that much either. When down as much, I should say, when it was down in like the 30s. So it's been pretty resilient, probably because of that dividend yield. But if we have another drawback to like $40 a barrel, they say they're committed to the dividend, but I mean we've seen that multiple times with Kinder Morgan, Conoco, even that as soon as like they can cut that at any point.
They have to say that.
Yeah, right. So I think that's a big risk holding Oxy at this point. But even so, I think their valuation with their Permian exposure, like you talked about, I think that's with these 4. I think it's probably one of the best plays. In terms of making a portfolio, I'd probably make that 50%, I guess. I guess for the rest, I might do Chevron. Chevron, Exxon, and Conoco, I think, have so many legacy assets that don't produce at the efficiencies that other more pure play companies can, like in the Marcellus for gas or in the Permian for oil. And they don't have, like they're buying into it now, but even so, with the enormous purchases that they're buying, I mean, Exxon blew like $4 billion 2 or 3 months ago on some Permian acreage. I mean, even with their asset base, that's really small and won't impact their bottom line. If it does, it'd be really marginal. That's why I don't like either of those 4, but if I had to put money, I'd put it in Chevron because I think they have a clearer growth profile. Conoco and Exxon are pretty much projecting out flat production growth through 2020. I think Exxon has a little bit of potential with like the LNG stuff at Gorgon and Weatherford. I think that's they have more of a story there, I think.
So I'd be 75-25 Exxon Oxy. You would be 50-50 Oxy Chevron.
Right.
And so I guess
I'll throw one more thing about Conoco is I don't get how they plan to like go long term without investing in investing in the business and exploring. Because you're an E&P, if you're cutting it back on exploring, you can't really grow your reserve base. You can't really grow. I mean, it's going to go down as you produce that base, so you can't really grow that base. And I think it's going to keep getting written down, like you saw with their oil sand project, because they're not economical anymore. I think as we stay in like this lower oil for longer, you'll see that more with a company like Conoco and Exxon and Chevron.
So I guess the question I would have here would be, when you're seeing these write-downs, they're using those barrels of oil reserve. They have to define whether it's going to be economical or not at current prices, right?
Right. I think SEC, something with the SEC rule is either the past year or like the forward strip.
Okay. So your view is that they haven't written them down enough yet.
Yeah.
Okay. So I guess I could definitely see that. I think.
Or it's just gonna stay bad, or it's gonna go down slightly more.
So I did a correlation matrix between Oxy and oil, and what I found was that, and actually all these 4 companies, and we found that between Brent oil, actually we'll use WTI and the companies, Exxon has a 0.57 correlation, which kind of makes sense. They're vertically integrated. They have that refining business, which has helped. Chevron is 0.74, Conoco is 0.67, which is kind of surprising that it wasn't higher, and Oxy was 0.83. So for my mind, I was underweighting Oxy a little more because I was unsure of oil. I think it's difficult to see oil going up and Oxy not going up. That said, I guess you're taking the point that you just don't see oil going much of anywhere, and in the meantime you're getting paid at Oxy and you have a better asset.
If anywhere, I see it going down, but I mean, gambling, that's basically gambling oil prices, and I don't really want to get in that business. But I mean, Oxy projects, I think, every year growing their production base 5 to 8%, which is significantly better than any of those other 4. I think they can do it at a cheaper cost too.
Are you pretty confident with these returns on capital that Chevron's going to get on the LNG? Because that's a big question mark for me, and
Yeah,
I think a source of risk. Yeah, huge amount of money, and they have that risk that, what if China starts actually producing its own natural gas at greater volumes?
They have a lot too. They just don't have the technology to get it.
So what if that happened, and then all of a sudden Australia is sitting with these huge amounts of barrels of LNG just waiting in ships that have no place to go? Mm-hmm. Is that a concern for you?
Yeah, it is. I'm willing to take that risk, I guess.
Yeah.
But yeah, I definitely acknowledge that that's a possibility.
Ben, I wanted to ask you what makes you more bullish on oil right now, if you have anything in mind. I know Krebs just said he doesn't like to just kind of blindly predict, but I mean, you obviously
at some point you have to, though, kind of like when you're dealing with this, you kind of have to.
I was wondering if you had anything specific in mind that just makes you slightly more bullish than 50%.
Well, I would say I'm bullish over a long time frame, so like over 3 to 5 plus years. In the near term, I'm not overweight oil. I'm not overweight energy stocks. I do think that they got a big lift from OPEC, and the idea that production was going to go down. In the near term, I think you've probably seen a little bit of an uptick in the global economy over the last number of months, which has increased the demand. But at the end of the day, I don't want to sit here and predict the oil price going up significantly over the next 12 months, because I really don't have a solid view on that. I think you could continue to see the US dollar appreciate, and that would make oil fall in comparison. So with respect to it, and you're starting to see US shale production increase again, I don't think OPEC ultimately has control. I think they're going to get back to the negotiating table probably within 6 months. That's my fearless prediction, that they get back to the negotiating table within 6 months and have to have another talk about cutting production because people have gotten out of line.
I think it would be really interesting to see what they do if oil by itself just falls back into the mid to low 40s.
Right.
Like what they do if they're saying, hey, this is scrap it, we're just going to keep pumping. That'd be nuts. Or if they say, yeah, we're going to extend this another, however, whatever, many million barrels, whatever they do. I'm really interested to see what they do there. So
in that context, I guess that kind of leads back into so I talked a little bit about Oxy, why I wanted to put 75 into Exxon, and I just think that their more diversified business gives them more downside protection. Also, what's interesting to note is that Exxon and Chevron were the only companies that didn't actually have losses in earnings per share in 2016. Both COP and Oxy both had losses. ConocoPhillips earnings were a little more volatile than Occidental's. Neither COP or Oxy are covering their dividend, and Oxy's quite a ways away from.
Chevron and Exxon are just, really they're just so different because they're integrated. They have, basically be like Oxy, Valero, and like Dow.
Right. Exactly.
That would be more comparable than just Oxy to Exxon.
Yeah. So risk reward, I think Exxon Mobil's in a good position here. Really, regardless of what Exxon does, primarily as a function of the risk side of the equation, not so much the return side of the equation.
That's a fair point.
Any closing thoughts? Anything left untold? You good?
We're long all stocks.
We are long Occidental, Exxon, Chevron, and ConocoPhillips.
Yeah.
Right.
So this has been the Investing Podcast. Stay tuned for more. Thanks.
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.